Assalamu alaikum. Welcome to lecture 13 of AAA, which is evidence and audit procedure. Now, before I start this lecture, let me tell you that the previous lecture, lecture 12 was on collecting evidence. So in that lecture, I will just give you a short recap of the previous lecture because this lecture is the continuation of the previous lecture. So in lecture 12, we went through how do we collect evidence. Then we went through initial engagements. What are the things you need to consider? For example, opening balances, then the audit procedures for comparative financial statements and corresponding figure and audit procedures in general. Okay. This lecture, we are going to cover audit procedures for specific elements from your financial statement, and also related party transactions and accounting estimate. What is the most important, the highlight of this lecture is the last part. So you need to watch this lecture till the end, because in the end I'm going to show you how to answer questions on evidence and audit procedure. There's an exam technique how to do questions on it, but it will be at the end of this lecture. And also the good thing is we are going to do two questions on this lecture at the end of this lecture. So you have to make sure that you watch this lecture till the end so that you get to know how to solve a question. I'm actually going to demonstrate. We are going to do real question and also the techniques, the guidelines to solve questions on this area. So let's start. Here we are going to cover on audit procedure, related parties, accounting estimates and exam approach. How to write answers for audit procedure. Very important, because audit procedure you will get 100%, you will get an audit procedure in your exam. Now it could be just in your question one, or it could be more than one question. It can come in 2-3 questions also. It could come in all the questions also, in fact. So you should always be prepared for audit procedure. And let me tell you, the examiner has told us from the experience, based on the past experience of the student, that audit procedure, even though it's very easy to read the answers, it is one of the challenging and difficult thing to write in your exam. Why? Because you need to be, you cannot memorize some audit procedures and just write it in the answer. No, you have to apply it to the scenario given to you. That is the hardest part. Okay, choosing the correct audit procedure, that is a challenge. You need experience, you need practice also. Okay, earlier you do questions on audit procedure, better it is. Okay, you will get so many questions on this area. It's a wide area. Remember, only this section is the huge area, section D, that is audit of financial statement. After that, the next section, section E, section F, section G, these are small sections. These are other information. Okay, so first item is property, plant and equipment. You should always, in your mind, you should automatically know which standard in your SBR links with this, because audit and SBR are very much linked. They are together. They are one part of each other. They are not separate. So property, plant and equipment in your SBR is dealt under IS 16. I hope you remember the rules, the cost and the revaluation model and the depreciation and all those things. Okay, so property, plant and equipment. Okay, this is a statement of financial position item. So that means you have to be aware of the 6 assertions, the balance assertions on balances. We went through the assertions in my previous lecture, lecture 12. Okay, the transaction assertions and the balance assertion. So this is the balance assertion, because property, plant and equipment goes in your statement of financial position. If something goes through profit and loss account, then it's a transaction assertion that you need to test. Okay, this is just some list. There could be more than this, but some of the element has been given. I didn't include all the elements. Some elements might not be in the list, which might be given to you in the exam. Okay, you have to be prepared for it. So first is you see, you verify existence. You see whether property, plant and equipment actually exist also or not. So existence is what? Look at the last word of this sentence. Existence is a assertion. It's a assertion. You should always write an assertion in your procedure. That means there should be an evidence, there should be a verb telling you what to do, and there should be a assertion. These three words has to be there. Okay. So here the assertion is existence, verify existence. Okay. The action that you're telling them to do is physically inspect, physical inspection, inspect. And what is the source of evidence? Asset register. Asset register is the source of evidence. From there you are collecting the evidence. Three things has to be there: source of evidence, your assertion that you're testing, and what you're telling them to do. The audit procedure, that is inspect, observe, review, recalculate, reperformance, analytical procedure. These are the words that has to be there in your audit procedure. Has to be there no matter what item it is. Okay. And one item will have more than one. It's not just one audit procedure for one item. No. Property, plant and equipment itself has around 7-8 procedure. But procedure will change depending on what you are testing. If you want to test existence, procedure will be something else. If you want to check occurrence, your audit procedure will change. This is for every element. Okay. So let's start with the existence. To check whether property, plant and equipment is actually there or not, exist. Okay. What do you have to do? Select a sample. You can use this procedure, by the way. I will not tell you memorize, but yes, this procedure will help you. For example, in your exam also you got property, plant and equipment, and there also you are asked to check the existence. Very easily you can write this if you know it. Okay. So you select a sample, because we know we test on sample. So select, because obviously if there are so many assets, you cannot test all the assets. That's why we say select a sample of assets. Wherever there are the item is huge, I mean there are so many items, for example so many assets, then we always write the word select a sample, select a sample, select a sample. Now we'll not say, for example, if it's a provision or a related party. Okay, if let's say there are 2-3 related parties only, or provision, we'll not say select a sample for provision. Why? Because provision is a thing which is estimate. You cannot take a sample of it. But assets, yes, you can. It is something which is objective. You can verify it. You can take a sample. If you have 10, 20, 30, 50, 100 assets, you can just take 5-6 samples and test. It depends on the type of the asset that you are having, type of the element. So asset, yes, you can take a sample. So select a sample from, what is the source of evidence? Asset register. You have to mention the source of evidence, that is asset register, because in the asset register they always list, it's a list of assets. So you take a sample from the asset register and physically inspect the assets from there to verify the existence. That is one audit procedure. Whenever you are given an item, think from all the possible angles that you could be, the audit procedures that you could give. This is the way you learn audit procedure. Okay, I'm telling you also a way to learn also. I'm explaining you the concept as well as I'm telling you how to learn. Okay. So when you're learning, because many of you have this problem, they struggle to study audit procedure because there are so many elements, so many audit procedure, they get confused. Where they have to write inspect, they write review. Where they have to do analytical procedure, they write something else. Because there are so many. It's a list, big list. You will soon realize as we go forward one by one. That's why when you are thinking of one item, think only about that item. For example, now we are in the property, plant and equipment. Don't go and write about sales, cutoff, classification, presentation. No. So property, plant and equipment, what are the possible areas? Make a list of it. One is existence, very common, because it's an asset. We want to see whether that asset is there or not. That property, plant and equipment is actually yours or not. What is there in the asset register? So you verify physically from asset register. Done. Second could be completeness, whether you have completely recorded the transaction or not. See, some audit procedures are it frequently comes. It's very common among anything like occurrence, existence. Not occurrence. Occurrence is a statement of profit and loss. It's a transaction assertion. But since this is a statement of financial position element, existence, completeness, this is very common. This is common across many. Okay. So another thing is whether you have completely recorded. For completeness, check. See, for completeness also, you inspect the asset register. Here also you take a sample of asset. Here also you inspect the asset register. Those are same, but what changes? Assertion changes. Earlier it was existence, now it is completeness. So what do? Something needs to change. The order changes. Select a sample of asset visible at the client premises and inspect the asset register to ensure they are included for completeness. That means whatever is visible in front of you is there in the asset register also. So it's complete. Third, remember it's an asset. Property, plant and equipment is an asset. So for an asset or a liability, if it's an asset, it's a right. If it's a liability, it's an obligation. You have to make sure that you have the right of that asset, that you own that asset, because some of you might have taken it under lease. Okay, so that's why you have to check whether you own it or not. That means what is the assertion here? Rights and obligation. Okay, rights and obligation is the assertion. That is what you're testing. Here you inspect. Inspect is the audit procedure. And from where? Now it changes. Your evidence, source of evidence is now registration documents. You will not get it in the asset register. Asset register just gives a list of assets. That's it. Now you have to see whether the title of the asset passed on to you or not. To check that, you have to look through the registration document of your client. Okay, registration document for the client's name. In the registration document, you have to look for your client's name. If it's under your client's name there, that means asset is yours. Now, fourth, what do you want to, as a, let's say this is your business, you want to check. What else you want to check for property, plant and equipment? The cost, the valuation, whether it is correctly valued or not. So what do? You go through the invoices. You just review some purchase invoice to verify cost valuation. Again, here audit procedure is review. Earlier it was inspect. Can you see difference? The source of evidence is purchase invoice, and the assertion that you're testing is cost or valuation. Okay, so review the purchase invoice to verify cost, because in your purchase invoice cost will be there. Now we have some more. We are not over. Now coming to the depreciation. Obviously, if non-current asset is there, with it comes byproduct is depreciation. So we'll talk about depreciation also. Okay. So for depreciation, what do you have to see? You have to check the reasonableness. Whether whatever the client, the depreciation rate used by the client is reasonable or not. That is what you have to assess. How are you going to do this? Don't just say assess whether it is appropriate or not. Review this, review that. No. What are you testing? From what place you have to do this? You have to write that also in your answer. So assess the reasonableness of depreciation rate. If you write this much, you will not get any mark. Even if it's correct, but it's half. You will never get marks for writing half a sentence. You have to write full sentence. Assess the reasonableness of depreciation rate by reviewing. Reviewing is the audit procedure. Because assess the reasonableness is not an audit procedure. You are just giving a way how to assess that reasonableness through audit procedure. What is it? By reviewing the budget, the company's capital expenditure budget. Because property, plant and equipment is a capital expenditure. Long-term expenditure, no? More than 12 months. That's why capital expenditure. Revenue expenditure goes as an expense in your profit and loss. That's why it's a capital expenditure budget. You have to check. Okay. Why the budget? To identify the replacement policy for asset. Then only you can be sure whether your depreciation rate is reasonable or not. Next, recalculate. So recalculate is the audit procedure. Then arithmetical accuracy is the assertion that you are testing, and depreciation charge. What are you recalculating? The depreciation charge. Okay. Why? See, depreciation is something that you have to calculate. It is you calculate through some formula, either straight line or reducing balance method, whatever. So you can recalculate such things, and it is based on estimate also. Later in this lecture, we are going to go through accounting estimate also. Okay. Depreciation is an accounting estimate. So to check the arithmetical accuracy, you recalculate. Next, assess valuation. Because it's an asset, you need to make sure that it is properly valued. So what do? You go and physically inspect the asset, condition of the asset, to assess valuation. And the last for property, plant and equipment is review any valuation report. Why valuation report? Because through valuation report only you can confirm the valuation. You just cannot write any valuation and put for your non-current asset. No, it comes through some valuation technique. So you need to review those valuation report and agree the revaluation surplus to other comprehensive income. See here you are using IS 16. If you know IS 16 very well from your SPR, this will help you, because according to IS 16, I'm assuming you know IS 16, okay? I'm not going to teach IS 16 again here. In case you forgot IS 16 evaluation method, go back to my SBR lecture. My SBR lectures are also there on my YouTube channel. You have to go to my SBR playlist, search for IS 16. It's there in the numerical order. The standard order wise I've given it. So click IS 16 and go to the revaluation part. Okay? And check for yourself. In case you forgot, if you remember it, you don't have to go through it again. Okay? If you remember it, it's a good thing. It's a very good start for AAA. In case you need to remember it also, you always can't refer notes for your SBR notes for AAA. Okay, so anyway, IS 16 says any revaluation surplus goes through other comprehensive income. According to IS 16 is a rule. Okay, so that's it. You have to use your SBR rule also, by the way, in your audit procedure. One of it is there. You will see this. The reason I've taken you very slowly through property, plant and equipment is because in others I'm going to go a little bit faster. Why? Because it's going to follow the same pattern that I followed here. The only thing is source of evidence will change. Your audit procedure, maybe recalculate, inspect, review, those words will be there. That will change, and assertion that you are testing. The pattern remains the same. Pattern of answering remains the same. These three things will be there. Assertion, source of evidence, audit procedure. These three words you will see in every place. Okay, so make yourself very familiar with these words: recalculate, review, inspect, observe, inquiry, analytical procedure. Okay, then all the assertions you need to memorize. You need to know the assertions. Source of evidence you need to know. If it's an asset, from which areas you can take, like register of asset, then physically you can verify, then valuation report like this. Okay, this much is enough. You don't have to know in depth. Okay, this much is enough. Knowing this much is enough. Same for the other elements that we are going to go through. Okay. At the end of this lecture, when we go through the exam technique, those are the same exam technique, but I've listed them in 4 stages. Whatever I'm saying right now, those are the 4 steps. Audit procedure, source of audit evidence, assertion that you're testing, and your SBR knowledge. Coming to the next element, investment property. Tell me which standard? IS 40. Exactly, it's IS 40. Investment property is a little bit easier. Okay, it has less rule compared to property, plant and equipment. Even this one is a non-current asset which comes under statement of financial position. It's an asset. So you are testing the balance assertion. Okay, now same thing. What do you need to check? Here also you have to check the ownership. In fact, any non-current asset you have to check the ownership. Like same like property, plant and equipment. Okay, but here also you inspect. The word is same, inspect the ownership. How can you do? Look at the title deed, whether the title has been passed to you or not. Okay, so inspect the title deed to confirm the ownership. Next audit procedure for investment property is discuss with the management. What is it? Discuss the use. What is the intention of the use? Is your intention for the investment is it to hold, or you want to use it? You want to use it for investment purpose, the property, or you want to use it for your own, personal use? If you want to hold the property for investment purpose, then only it comes under IS 40. If it's for your own use, then it does not come under IS 40. Okay, that's why you have to discuss this with the management. This was not there in property, plant and equipment. Why? Because property, plant and equipment, there is no intention. You always hold it for long term. For long term only, it's there in your business, which gives you a return. Okay, it's there for your own purpose in the business. Cash comes in, benefit comes in only through that non-current asset. But investment property, yes, you might hold it for some time. You might change the intention. You might hold it for your own use or for investment purpose. That's why you have to discuss the intention with whom? Management. So the source of the evidence is from management here. Third, physical inspection. Here also you have to physically go and check the building, like property planning equipment. Okay. And you have to see whether it is not occupied by client, because if it is occupied by client, it is not an investment property. Investment property means you work on the capital gain, capital appreciation. Value of the property, if it goes up and down, you are the one who are gaining and losing. You are not going and occupying it. Okay. Then, if the property is rented, what happens? See, if it's rented, you have to see whether it is paid or not. You have to confirm the payment. How? Go through the rental agreement, go through the bank statement and the cash book for the receipt. Okay, you have to confirm the receipt. This was not there in the property planning agreement because that we don't rent. That's why we didn't have to go through bank statement, cash book and all those things. It's for long term. Here, yes, rental payment comes, you have to check. Then we have some more. Obtain an independent expert's market valuation of the property at the reporting date to determine the fair value. Here you need an independent valuation. Then gain and loss. As I told you, investment property works on capital gain and loss. So that gain and loss you need calculate. Okay, you can calculate that gain and loss to see whether it is confirmed with what is there in the statement of profit and loss. And remember, this gain and loss goes to profit and loss. But in your property plant and equipment, we have seen revaluation gain and loss goes through other comprehensive income. That is IAS 16 rule. But IAS 40 says statement of profit and loss. Okay. You see, at the end, they always use the rule IAS 40. So any disclosure, you have to review the disclosure also. Remember, it is not only assertion, it is also the disclosures also it comes. Okay, the balance, transaction and disclosure, three things. Even the disclosure audit procedure has to be done for that also. So you review the disclosure made in the financial statements. Obviously, you will be making some disclosure regarding investment property according to IAS 40. That also you have to review. Because you have to make sure that you are complying with IAS 40. Always. Any standard, make sure you have to review that you are complying with the standard or not. That is one audit procedure which is common for all the element. Third element, development cost. Development cost comes under intangible assets. If you know intangible assets, which standard am I talking about? IAS 38, exactly IAS 38. Development cost, we know we have a choice. If it meets certain criteria, development cost we capitalize. We put it as an intangible asset and amortize it. Otherwise, it goes as an expense. This much you know through your SBR. Okay. Now, what we do with development cost audit procedure? We can check the arithmetical accuracy. One would be, we might be worried about the arithmetical accuracy. So what do we do to check the accuracy? We break down the capitalized cost and check it with the financial statement. Next, we take some sample of cost from the breakdown and agree the amount to invoices or timesheet to confirm accuracy. Third, we inspect board minutes for any discussion relating to the intended sale or use of the asset. See, board meeting is a very valuable source of evidence. Why? Because through that you can know a lot of things, especially when major changes are happening place. If you are going through acquisition, merger, board of meetings will help you. If some legal cases is there against you, board minutes is there for you. Okay, some intangible assets, some goodwill, whether you are acquiring or selling, board minutes. So board minutes you will see, in fact, in many audit procedures, this board minute is there. Okay. Next, budget. This is also for developing something also you need a budget, no? So that also you can inspect for next few years. Because based on that next few years, what would be your intangible asset? Okay, you can decide your amortization. Same for non-current asset, we have depreciation. For development, because it's an intangible asset, we have amortization. We amortize intangible assets. So amortization policy is the one you have to check. How we checked reasonableness? Here we check reasonableness of amortization through budget. We have some more. Which standard? IS 38. So here also discuss the details of the project with the project manager. If you have some project in hand, discuss it with the project manager to check whether you are complying with IS 38 or not. Next, inspect. And also documentation also. Those also you have to inspect. Then inspect budget to confirm financial feasibility. Remember, development cost, for it to be capitalized, the project should be financially feasible. If it's not financially feasible, you cannot capitalize development cost. That's why you have to check financial feasibility through budget. Then IS 38. Everything you review through draft financial statement, because by the time you come to the final financial statements, you will not have a chance to review it again. Through draft only you review and make the changes. Okay. It is the same like IS 16 and IS 40. Coming to the fourth, goodwill. Goodwill is also an intangible asset, but this goodwill we are talking from the point when we acquire a subsidiary. Okay. So here, what do? It is related to accusation. We review the legal documentation. Why? Because I told you, through goodwill, through accusation comes goodwill. So you have to check your legal documents whether accusation has taken place or not. Because in that you can calculate, you can confirm the figure. What are the figure? What is the formula for goodwill, by the way? A very good question. It is your consideration, fair value of consideration that you have paid, plus your net as NCI, if you have any NCI, non-controlling interest, minus your net asset. Okay, so to check the consideration that you have paid to acquire, to check whether it is accurate or not, you can go through the legal document. There consideration paid will be there. Okay, because if your consideration paid is correct, only your goodwill calculation will be correct. It will be accurate as well as complete. Next, purchase documentation. Because you have purchased an accusation, so through your purchase documentation you can see how much shareholding you have acquired, 30%, 40%, 70%, what? Why? Because it tells you whether you have acquired a control or not. Okay, if it's a control that you have acquired, it's a subsidiary, you have to consolidate. That's why. Next, because it's a good transaction taken place, accusation, you must have paid something. So that some things you agree through bank statement and cash book. Whoever have acquired, you check their cash book and the bank statement to agree the cash that they have paid. Again, I told you, accusation. So board minutes will be there. So you review the board meetings because they must have discussed about accusation there. Okay, and whether board have approved it or not, it will be there in the minute of board, because before any accusation takes place, board has to approve for it, and it will be there in the minute of board. Next, we are moving on. That one was for cash consideration. That is easy. Check your cash book and bank statement. What if your consideration to acquire is contingent based on some condition? Then contingent is something based on some condition that is going to take place in the future. That's why you need to calculate the present value for that consideration. Okay, so in calculating present value, you must have used some assumption. Okay, evaluate those assumptions now. Also check the probability of the payment. How? By obtaining revenue and the profit forecast. Then you have to discuss with the management the interest rate that is used in the calculation. You must have used some interest rate to discount, right? Discuss it with the management and check whether that interest is going in line with the client's weighted average cost of capital. Then, as I told you, non-controlling interest, it is measured at fair value, right? So that fair value you have to confirm. How? By you calculating the fair value of NCI. How can you do that? based on the share price. At the date of the acquisition, what is the share price? It must be externally available to you. Based on that, you calculate. Okay, and make sure that that share price agrees with the management's calculation. Next, if applicable, you can obtain a copy of due diligence report also. Why? To review for confirmation of acquired assets and liabilities and their fair values. Because according to IFRS 3, okay, everything needs to be measured at fair value. Business combination. If you have acquired a subsidiary, all their assets and liabilities needs to be measured at fair value. That's why you have to confirm. That is at fair value. So, as I told you, two standards deals with it: IFRS 3 and IFRS 13 fair value measurement. Okay. You have to make sure that it confirms with IFRS 3 and IFRS 13. Now, review the calculation of net asset. For goodwill, we need net asset also. What are the things we need for goodwill? Non-controlling interest, we have covered that. Consideration, both cash and contingent, that we have covered. Now net asset. See all the possible areas you have to think about. The more you do questions on it, the more you will remember. Automatically you will remember. It will be there in your subconscious mind. You don't have to consciously remember. So you don't have to try so hard to remember it. Okay. And this usually happens if you're very thorough with your SBR standard. Automatically it comes to you. Okay. Like 2-3 audit procedures you will automatically get based on the formula of goodwill. Like we need non-controlling interest. Okay. You know that fair value. Then you check share price. So we got one. Then we know net asset. We got another audit procedure. Then we know IFRS 13 and IFRS 3. Another audit procedure. Then we know consideration, cash and contingent. Another 2 audit procedures. So at least 4 to 5 audit procedure I've just picked up just by knowing the standard, my SBR standard relating to goodwill. Like that for others also you can do. Okay. But obviously go through the list. Go through this list that is given in the lecture. It's a very good list. The more you go through it, try to recall it, the more you remember it. Better it is for you. Okay. You have to do this on everyday basis. Okay. So now for net asset also you recalculate. You review the calculation of net asset and check that group accounting policies have been applied. Group accounting has to be there because after acquisition only goodwill comes. Okay. Goodwill is pretty long. Okay. Anyway, see, like non-current asset we have depreciation. Depreciation is a byproduct. It will come with non-current asset. How for intangible asset development cost we have amortization. It's a byproduct. For goodwill also we have a byproduct known as impairment. Impairment comes under IS 36. Okay. So you have to review impairment also. So review management's impairment calculation. And remember, whatever is based on estimate, you have to evaluate the assumption. All the estimates are based on some assumption. Those assumptions you have to evaluate. So impairment is also based on estimate. So you have to evaluate the assumptions to assess the reasonableness. Okay. Review. What's next? Cash flow focused. Why? To assess whether the subsidiary is expected to generate future cash flows in excess of the carrying amount or not. In your cash flow focused, through your cash flow focus, you'll be able to know it. Even though it is something to be known in the future, but anyway, through at least focus, you will have some idea whether that subsidiary is expected to generate cash flow or not. And IFRS 3, obviously, check. Leases. Next, leases also is a statement of financial position balance. Again, non-current asset. And with standard IFRS 16. Okay. So here you can obtain a copy of the lease, which is signed by the lessor, okay, the buyer, and review the major clauses in that lease. Because see, whenever you are reviewing a contract, try to review a contract. The clauses are very important in that contract. For example, if you are taking a bank loan or any type of contract, always review the clauses. Lease is also like that. It's a contract. So review the major clauses. One major clause is the option to terminate or extend the contract. Okay, review that. Next, lease payment. We know it is based, we calculate the present value, right? So present value of the lease payment you calculate using the appropriate discount rate and compare this with the client's calculation. And make sure that it agrees with the initial recognition of right of use asset and lease liability. We are talking from the point of lessee, not lessor, lessee. Because lessee is the one who is going to recognize right of use asset and lease liability, the one who has taken the lease. In case you forgot the rules of IFRS 16, please go back to my SBR standards, my SBR lecture IFRS 16, and go through the lessee accounting. Then again, as I told you, byproduct comes with everything. Remember the byproducts. Right of use asset is an asset, with that comes depreciation. Okay, so you calculate that depreciation. Okay, and when you are taking the depreciation, take care of the option to extend and terminate, because that will change the useful life of the asset, useful life of the right of use asset for depreciation purpose. If it's terminate, it will reduce the useful life. It's extend, it will increase. Okay, and also discuss the probability of the option being exercised with the management. Remember, and ensure depreciation calculation takes this into account. So depreciation, when you are calculating depreciation, the option to extend or terminate should be taken into consideration. Then leases, obviously same like rental payment for investment property. Lease also you must have made the payment. So confirm this with the bank statement and cash book. That's why you inspect. Then physically go and inspect the lease assets. Any type of assets, it's always good to physically go and inspect, like stocks or non-current asset or investment property. Okay, physically go and inspect. Same for leases also, to confirm that it exists and it is being used by the client. Now with leases comes finance charge, because you have taken it on lease. Okay, finance charge will be there, interest you have to pay, so recalculate that finance charge. Then if it's sale and lease back, okay, for sale and lease back you have to see whether IFRS 15 you have complied with IFRS 15 or not. That means whether a sale has taken place or not. If a sale has taken place, then the rules are something else. If it's not a sale, then the rules are something else. It's there in my IFRS 16. Okay, you need to go and check there. And IFRS 16, make sure you comply with it by reviewing the financial statement, draft financial statement. Moving on to the next, government grant. This also comes under assets only. You can take it as an asset only. Okay, government grant, which standard in your SBR? IS 20. Okay, this is short standard, so audit procedures will be less only for this. Okay, here also documentation. So obtain the documentation relating to this grant and review to obtain the understanding of few things. One is terms of the grant. That means what is the particular requirement relating to that specific use of fund. Next, date by which the fund must be used. There's some time limit that government always gives, okay, with the grant, that during this time you have to use this grant, otherwise you cannot carry it forward. Third, any clause, same like leases, we have a clause here, okay, relating to the repayment, when it should be done and under which condition repayment comes. All this you have to have an understanding looking at the documentation. Next comes, same like leases, investment property, we make a payment. Here also you have to agree the payment with bank statement and cash book. So agree the amount received to the bank statement and cash book. Okay, this is something you must be pro by now. Anyway, coming to the third one, discuss the use of grant with an appropriate person to confirm that the grant is to be used as intended by the government. Remember, you have taken the grant for something else, you cannot use it for something else. You have to use the grant for the purpose you have been taken. Okay. Then obtain a written representation from the management that the grant received will be used for the specific purpose. Management have to give it in writing that whatever the reason they have taken the grant, it will be used for that purpose only. Now we are coming to the share-based payment plan. This is under IFRS 2 in your SBR. Okay. Here, when you are giving share options and all to your employees, it's kind of an expense. Okay, so here you have to test your transaction assertions. Okay, so you can obtain a copy of detail of your share-based plan and review how many options are granted, the vesting period, agree the share price at the grant date to stock market records. Okay. Third, assumption. Here also you are making some assumption that you expect that this many options will be expected to be exercised. So you have to discuss those assumptions now. With whom? Management. And assess the reasonableness of the assumption. Then calculate. Calculate the expected cost of the share-based payment and amount which should be recognized in the current. And agree this to the statement of profit and loss. Why? Because it's an expense. It goes to profit and loss only. That's why you have to agree with the statement of profit and loss. With standard IFRS 2. Now, revenue recognition, very important. I'm sure many of you like this area also by now. So, revenue recognition with standard IFRS 15. Here, review the contract and have an understanding of this performance obligation. You need to understand whether you are satisfying the performance obligation at a point in time or over a period. Next, transaction price. Whether the price is fixed, variable or combination of both. Then, supporting documentation you have to inspect. Why? To check whether you have satisfied the performance obligation or not. How? What are the supporting documents? Like dispatch note, stage payment made, significant milestones achieved. Okay. Then, if you have made any payment made by the customer, okay, any payment that customer has made which cannot be recognized as a revenue, then you have to recognize it as a contract liability. Okay, you have to confirm it. And if your transaction price is variable, you have to check. Okay, assess whether it is highly probable or not to receive it. Next, same, agree the payment with the bank statement and cash book. Payment that you have received from the customer. Then calculate the amount of revenue and agree this with the statement of profit and loss. Review documentation relating to the progress towards fulfillment of performance obligation. And review the correspondence with customer. Okay. Then only you can see whether you are progressing ahead or not with the contract. Okay. If you're not progressing ahead, do not recognize revenue. Otherwise, recognize. Okay. Now, inventory. IS2. Okay. IS2 says recognize inventory lower of cost and net realizable value, NRV. So for damaged and obsolete, it is at NRV. You have to inspect your inventory listing to check whether it has been written down to NRV or not, especially for damaged and obsolete items. Then inspect the inventory listing again for the items on the goods received note and goods dispatched note, GRN and GDN. Because through this you can ensure the cutoff is done correctly. Trace item. Trace is also an audit procedure. Trace item on the count sheet obtained during the count into the inventory listing. That means whatever is there in the count sheet, make sure that it is there in the inventory listing also. Okay. To make sure quantities did not change from listing to sheets to inventory listing. Calculate the inventory holding period. Okay, see, you can use analytical procedure here. How? Calculate the inventory holding period and compare this with the previous year. And if you see your inventory is moving slowly, you have to make sure you're writing it down to NRV. Next, there must be some old inventory, right? You have to inspect for those aged inventory listing. Okay, and you have to make sure you discuss this with the management to write it down. For the cost of inventory, inspect the purchase invoices, because in your purchase invoices it will be there how much inventory you have bought. Okay, you should always know the place where you are going to record when some transaction has taken place. Always, this helps you a lot in audit procedure. Okay, some of you might struggle. For example, how will I know what is the cost of inventory? Through what document? This you should know, like purchase invoice. Okay, so inspect this post year end sale invoice to verify NRV and make sure inventory is written at the lower of two, the cost and the NRV, because IS2 says so. And review calculations of overhead included in work in progress. There will be some inventory that is under work in progress. You have to review the calculation of overhead on that area. And only production related overheads are included. Make sure. Receivable. For receivable, directly ask your customer. Direct confirmation from customer. Then confirm the goods dispatched note and invoices to make sure accuracy. Then year-end cash receipt. Inspect the year-end cash receipt to confirm the valuation. Calculate the receivable collection period and compare it with the credit terms to assess the recoverability of the debt. Because if your collection period is increased, if you are giving more and more credit terms from 30 to 60 to 90, you are increasing, remember your recoverability of debt also reduces. You are going to have more and more bad debts, which is not good for the company. That's why you have to calculate receivable collection period. You can inquire your management about long overdue debt and discuss to write it down with the management. Inspect the correspondence with customer to check it's an evidence for dispute, okay, which may indicate overvaluation. Okay, and evaluate the reasonableness of the basis of the loss allowance and recalculate. That means what is your basis for loss allowance on receivable? How do you calculate it? Evaluate. Bank. For bank, audit procedures are obtain a confirmation letter from bank. Why? To verify rights and existence. Then, for accuracy, bank reconciliation. Then agree the ledger with the cash book. Agree the balance per the bank statement to the bank letter. Agree. This is more like agree because bank is something which is very easily, it's an objective item. Not much estimates are used here. So it's a good thing. Most of the things you have to recalculate, agree and all those things. It's more of calculation. So agree the unpresented check. Okay. To the post year end bank statement to confirm they have cleared in a reasonable time. The outstanding balance you need to agree, okay, with the cash book and the bank statement. Payables. For payables, invoice, purchase invoice. If you have taken something on credit, purchase something on credit, only payable comes. No, that's why purchase invoice you have to inspect. And also goods received note to check the accuracy. Next, obtain supplier statement reconciliation, so that you can see if there is any discrepancy. Discrepancy means any difference between your amount and the supplier's amount. Why? Because if there is a difference between you and your supplier, it affects three things, three places. Completeness, it's not complete. Existence, you don't know whether your payable are actually existent or not. Or valuation assertion, you don't know whether your payable is correctly valued or not. That's why. Obtain direct confirmation of balances from suppliers, where supplier statements are not available. Directly you ask for confirmation from your supplier where you cannot get their statement. Then for payment, bank statement. Okay, inspect the bank statement, which may indicate unrecorded liabilities also. Here also, like receivable, you calculate the payable payment period, compare it with the credit terms, and see any unusual differences and discuss it with the management. And inspect the good receivable note before the year end to ensure completeness. Provision. Which standard deals with provision? IS 37. Yes. Here also you have to check the reasonableness. Okay. Because provision is some estimate, that's why you have to inquire with the management the basis of the provision to assess reasonableness. Recalculate that provision for arithmetical accuracy. Get a written representation from the management for completeness and adequacy of provision. For legal provision, you have to get confirmation from your lawyer, both of the amount and the probability. Provision, inspect board meetings to confirm that obligation exists at the year end. Because to recognize provision, remember, by the year end, obligation should exist. And this obligation you will get through board minutes. That's why you have to inspect board minutes. Review subsequent event for progress affecting the value of provision. Remember, value of provision changes if there is any subsequent event affecting provision. That's why you have to review subsequent event. And my next lecture is going to be on the subsequent event only. Going concern issues and all those things. Not next lecture, but I think after 2-3 lecture. That will be my section E of the AAA syllabus. Then inspect the cash flow forecast for the payment. Any payment, cash flow forecast and bank statement only. Okay, and check that whether discount has been correctly applied or not. Okay, so we have finished almost all of the specific element. Now there are 3 areas. Okay, specific considerations for selected items. Okay, one is inventory. Okay, to check the condition of inventory or existence. Okay, go and attend the inventory count. Go and be physically present there and see how they do the inventory counting. Next, this is how you do it. You see how managers are giving instructions over the inventory count. Second, you observe the count procedure. Then you inspect the inventory and then you perform the test count. Okay. Perform the procedures over the final inventory record to ensure they reflect the actual inventory count result. Actually, what you have counted, make sure it is there in your final inventory record also. Next is litigation. Okay, that is regarding provision and all. Here you have to ask your manager. Okay. Next, review minutes of meetings or meetings with your counselor. Inspect your expense, legal expense. And if there is a significant risk of material misstatement because you have not identified litigation, then directly communicate with the the lawyer. Third is segment information. Segment information is dealt in IFRS 8. Okay. Here, you need to understand, evaluate, and test methods used by management to determine segmental information. How do they determine segmental information? Next, perform analytical procedure in this area. Okay, so that's it. We have finished the first part of this lecture, that is audit procedure for specific items. Now we are moving on to the next. We are going to go through audit procedures for this also, but we are going to go through this topic more in depth, not just audit procedure. It is not just limited to audit procedure. We are going to go through the risk of related parties, why we need to disclose related parties, the nature of related parties, and etc. etc. Okay. So, related parties. In your SBR, IS 24 is the standard which deals with related parties. Okay. According to IS 24, you should know who are your related parties, which entity are your related parties. Exactly same thing has been explained through this diagram. You will not be asked in your exam to draw diagrams, but diagrams are always easy for me to explain things in more simpler way than just through words. Concentrate in the first half of this diagram, top part. Above the entity, you can see the entity is in the in middle, right? Above that we'll consider, below that leave for now. So owners who are related. Okay, owners relating to the entity. How owners are related to the entity? If they have a joint control, if they have a significant influence, or if they have a control, and also if they are the key manager of the entity, then they are said to be related parties to the entity. An entity could be related to another entity. How? If it's a subsidiary, that means subsidiary is related to parent. If it's an associate, if it's a joint venture, if it's a pension scheme, because pension scheme is also often dealt through another entity. That's why. So if it's subsidiary, associate, joint venture, and pension scheme, okay, that means an entity is related to another entity. So now, keeping this in mind, what are the risks with related party? See, related party has a very high chance of being manipulated. Okay, that means your financial results can get manipulated. Why? Because related party transaction does not happen at arm's length. Arm's length transaction happens in the market prices, where everyone pays the same price and gets the same price. But in related party transaction, you can change the price based on for your own advantage. That means it is not at an arm's length. That's why you need to pay close attention to related party. Okay, so in this circumstance where a transaction is not at arm's length, what should you do? You should bring this to attention to shareholder, okay, through disclosure. Therefore, that's why we have the standard IS 24 related party disclosure. Understood? Now, to do that, auditor have to have sufficient and appropriate evidence. Okay. That related party has been dealt according to IS 24. Okay. Now, disclosure. So these are the disclosures that are made. First is the nature. Then it is the information about the transaction. For example, the amount and outstanding amount. Then any allowance for doubtful debt. Because if you are doing any transactions with related parties, there is a high chance that they might not be able to pay you back, or they might not pay you. So that's why we are talking about doubtful debt and all. Okay. Now, risk. Remember, it is very difficult to spot this kind of the related party transaction from the other transactions. Why? Because of this reason. Number one reason is directors. Directors are very reluctant to disclose transactions, related party transactions, especially if it's a family business. Second, these transactions are not easy. You cannot, by just looking at your financial statements, you cannot say this transaction is to related party, this transaction is normal transaction. You can't say that. It's very difficult because they are together. They're not separated. All the transactions are listed together only in the accounting system. Third reason, the employees, the executives, okay, they might conceal the transaction, the related party transactions entirely or in part from auditors due to for fraud, okay, for fraudulent purposes. Because of this reasons, this is a risky area. That's why by nature, related party transaction is deemed as material, not by the quantitative threshold that we have looking at revenue, asset and profit, but the nature is such. Now, indicators of related party transactions. What are the indicators that says that it's a related party transactions? You have to know this also. It's very important. First indicator, when a transaction is very complex. So in the scenario given to you in your exam, you have to check for these things. If a transaction is very complex, chances are transaction that is done could be between related parties. Why? Because if the transaction is complex, it's very easy to hide related party transactions through complex because no one will understand the system and it's easy to fool. If the system transaction is very simple, it's difficult to make related party transaction because it's easier for auditor to test. That's why. Where transactions are done on an abnormal terms of trade. Remember, normal transactions are done in normal terms of trade, which is very easy to check through documentation. Third, transactions which does not appear to have logical business reason. You do not understand why even they are having transaction. Fourth, it is not processed in the usual or the routine way, how other transactions are done. Then transactions, high volume of transaction or transactions with a high value specifically to one particular customer or supplier. Okay. Then transactions which are not recorded, like rent-free accommodation or services at no cost. Okay. Sometimes it happens, right? You might give your own accommodation to your relative free of cost, or you are giving them services at no cost. So you do not record this transaction, right? Now comes risk assessment. Because it's risky, you have to do a risk assessment procedure. That means auditors should have an understanding of the related party. They should know who the related parties are. They should know the nature of the relationship. They should know the purpose of the transactions. Then they should check whether control has been implemented by the client or not for this related party. That means for this transaction, whether client is approving and authorizing it or not. Now, further audit procedure. Okay. Now we are moving on to our main theme of this lecture, which is audit procedure in general. So audit procedures relating to related parties. Inspect the prior year working papers. Next. Inspect the shareholder records for identifying principal shareholder. Okay. Then, third, inspect minute of shareholders meeting. Inquire other auditors involved with the audit. Inspect the tax return, income tax return. Next, where not prohibited by law, auditor should do this. Confirm transactions with law firms, banks, or other intermediaries. Because obviously you must have done the transaction through the bank, so you have to confirm it with the bank to check the amount, the volume, or with the law firm or other intermediaries if you are using any in-between person for the transaction. Then confirm the terms of related party transactions with those related party. Third, read the financial statement. Okay, to get the related party or other relevant financial information of the related party. as an evidence. Now, if the auditor identifies related party that are not previously identified or disclosed, they should do these things. Communicate it with the management, okay, or sorry, communicate it with the rest of the engagement team, then request the management why they failed to identify the related party, okay. Then perform substantive procedure relating to transactions with the client. Reconsider the risk. Remember, now you have to change your risk. You have to reconsider the risk that other unidentified related parties also may exist. It's just not that you identified one or two related parties, that other related parties might not be there. There might be, which you have not identified. So there's a risk of that also. Evaluate implications of non-disclosure by management appears intentional. If managers say we do not want to disclose such transaction and it appears that is very intentional, it's highly unlikely that is not intentional, it's accidental. No, I mean, why would then manager do not want to disclose it, right? If the related party transaction is outside the normal course of business, auditor should do this. Number one, inspect the contract to establish the business rationale. Through contract, you will see what is the business reason. Second, terms of the transaction. Third, whether disclosure has been made. Obtain evidence that the transactions are properly authorized. Now, we are moving on to the next part, that is accounting estimate. So we are over with audit procedure for the relevant items like property, plant and equipment, development costs, leases. Then we went through related party. Now we are moving on through accounting estimate, that is dealt according to the standard. IS 8, exactly. So accounting estimates are risky. Remember this. It is inherently risky. Okay, accounting estimates are inherently risky. That means no matter whatever control you put or before the control you put, there will be risk. Why? They are judgment. You have to use judgment. It is subjective. Okay, and management judgment is used here. So as a result, through estimate you can manipulate financial statement. Okay, that's why it's difficult for the auditor to obtain sufficient appropriate evidence for accounting estimate. If you want to get sufficient appropriate evidence for your cash flow, it's very easy. You can check bank statement and cash flow and match. But for accounting estimate, because you are using your judgment, difficult. That's why you have to use professional skepticism here more for accounting estimate. Okay. Auditors are required to have an understanding of this thing. Number one, the environment. Okay, the entity's environment that require them to apply financial reporting framework, especially for accounting estimate. What is the framework? Next, the control system of, the internal control of the entity. You have to see for your accounting estimate what is the internal control. Okay, for example, do they have the specialized skills to estimate the accounting estimate? Do they have the governance in place relating to estimate? Okay, how managers review the outcome of previous accounting estimate and respond to the result of those review. Now, auditor must separately assess inherent and control risk. There are two things. I have covered this in my earlier lecture. One is known as inherent risk. The other one is known as control risk. Okay, I'm sure you know both. I'm not going to explain you both the terms here. Okay, this is relating to accounting estimate only. So when assessing inherent risk, auditor should do this. Inherent risk means whether you apply the control or not, this risk will be there. Risk is degree to which the estimate is subject to estimation uncertainty. How uncertain the estimation could be. The more uncertain it is, the more the inherent risk is. Second, how complex and subjectivity is involved in the method, assumptions, and data used to make the estimate. If the data that is used to make the estimate is complex, more subjective, then inherent risk is more. When the managers are selecting their own estimate, how complex is it and how subjective it is matters. Now, how managers, auditors respond to the risk of material misstatement for accounting estimate. These are the procedure. Responding to the risk means designing audit procedure only. Okay. They obtain evidence from subsequent event. Why subsequent event? See, I'll tell you why. Accounting estimate is a thing which it's not that you have applied last year and you are not going to apply it this year. You always have to check that you are consistently applying the accounting estimates in all the years or not. So it is going to affect in future also, subsequent event. That's why you have to make sure that accounting estimate you are applying it for the subsequent event also, or whether through subsequent event your accounting estimate changes. That's why you have to collect evidence for subsequent event. Next, test how management made that estimate. Third, you have to develop an auditor's point of range of estimate. Now, examples of balances where estimates are relevant. Like this areas, more estimates are there. Defined benefit pension scheme. Share-based payment scheme, because it is something based on share option that they are going to exercise in the future. Estimate. Defined benefit pension scheme is also like that. Pension in the future only. You don't know how much it will be worth. Investment in share, same thing. Investment property, same thing. Capital appreciation, up and down, you don't know. You make an estimate. Property with PPE, if revaluation model is used. In revaluation, yes, estimation. And net asset of subsidiary. Again, estimate of fair value. Now, that's why we move on to fair value accounting estimate. So for fair value, you must have seen a lot of standard in SBR requires fair value. To calculate that fair value, estimates are used. Okay. So in case of fair value estimate, what happens? Make sure you are hiring sufficiently skilled and knowledgeable people in your team to estimate that fair value. Okay. Because if you are taking sufficiently skilled and knowledgeable people, okay, that means you are also complying with the quality procedure. Now, depending on the nature, complexity, and the materiality of fair value, okay, management representations about fair value and disclosure may include representation about the following. Okay. Number one, what is the appropriateness of the measurement method that you have used to measure fair value, and how consistently are you applying it, the method. Next, completeness and appropriateness of disclosure related to what? Fair value. Did you appropriately disclose how you have calculated fair value, as well as is it complete? Then, whether subsequent events require adjustment in your fair value. Fair value changes due to subsequent event. Now, that's it for this lecture. Now I'm going to wrap up this with the approach to exam questions. Remember, I told you in the beginning of this lecture, we are going to have the techniques to pass this question. How? 4 steps. First step, identify assertion that you are testing. As I told you, whether it is completeness, accuracy, cutoff, classification, presentation, right and obligation, valuation, allocation, what are you testing? Be very clear. Second, for example, okay, through example I will explain you this. Let's say payroll cost. Okay, you want to confirm the completeness of payroll cost. What do? You reconcile the total number of employees in your HR list and total number of employees in your payroll list. They have to match. Okay. Next, if you want to check the occurrence, then just take a sample of employees in the payroll list with the and perform physical verification of sample of employees to make sure that payroll costs have actually occurred. To actually occur, there should be actual employees. That's why you have to physically verify the employees with the payroll listing. Okay. And this payroll listing, from where should you get? From contracts of employment, because whatever employee comes in your business will be there in your contracts of employment. They only will be there in the payroll listing because they will be paid. To confirm the accuracy, take the payroll listing to the payslip. Now you see, for each assertion, audit approach changes. Sorry, audit, procedure changes. If it's completeness, you check something else. Occurrence, another way. Accuracy, from another place, like that. Moving on to the second step, identify the sources of evidence available. For example, for HR, I'm using the same for payroll cost. Okay. Let's say here the evidences you have obtained are from which places? Payroll listing, HR listing, payslip, timesheet, contracts of employment. These are your evidence. If you want to get some further evidence, you can use your bank statement and cash flow to confirm the payroll payment. Third, identify the types of procedure auditors can use. For example, analytical procedure. This is to calculate ratios and all, to compare with the previous year, to find any kind of fluctuations. Like, let's say you calculate salary, average salary per employee, and compare it with the previous year. Or you can inspect, or you can recalculate, review, recalculate, reperformance, inspect, observe, inquiry, analytical procedure. I told you there are so many audit procedure. They will have these words. You can inspect a sample of contract of employment to confirm the salary of each employee and trace through to the employee's payslip. Or you could recalculate the payroll listing to confirm the arithmetical accuracy. I told you this before. Evidence source has to be there, audit procedure has to be there, and assertion that you're testing. And finally, the fourth one, accounting standard, the relevant accounting standard that you are complying with. You have to understand the requirement of that standard. For this, you have to know your SBR. Okay. Let's say legal provision. So for legal provision, IS 37. Okay. Here you obtain confirmation from lawyer regarding the probability of the claim being successful. Then you inspect the board minutes to see whether obligation exists at the year end or not. If obligation exists, means it's likely that claim will be there. Okay, it will give rise to a claim. Okay. So that's it for this lecture. Now I'll be going to do 2 questions. But before I move on to the 2 questions, let me summarize this lecture. We have started with evidence. We went through estimates and fair value and related party. Okay, specific audit procedures I'm not putting it here because it's impossible for me to summarize it. Everything is important. Just go through all of it. Non-current asset, development cost, intangible asset, leases, provision, payable, receivable, revenue, right? All. For estimate, inherently risky, subject to management bias, you need professional skeptical. You have to test the manager's process of making that estimate. For related parties, material by nature, it increases audit risk. Managers might not want to disclose related party transactions, which is RPT. Therefore, auditor needs to look for this unclosed RPT. Okay, so now let's do the 2 questions relating to this lecture. Test your understanding 1. So in this question, you have been given valuation for a brand that is 700,000, and you have been asked to design audit procedure for a brand, valuation of the brand name, for 5 marks. 5 marks means you have to give 5 audit procedure, okay, because one audit procedure is for 1 mark, so 5 audit procedures you have to give. But if you see the answer, it's even longer than that. They have given you 9 points because they always give you all the possible answers. Okay, so I will write very briefly. Okay, I will list down the audit procedure for the brand name because I want to show you how to write audit procedure. There's a way to write audit procedure. We went through it also, the 4 steps. So let's do that. And in audit procedure, good thing is there is no order. I mean, you can write the audit procedure in any order. Okay, that it should not be that you have to first test this assertion or that assertion and it should be in this order. Nothing like that. In anything you can test first in any order. Okay, so first is we'll talk about, see, wherever figures are there, good area is start with the figure. One figure is there, so we'll just talk one audit procedure using this figure. What can you do? We'll talk about this. They have given it at 700,000 according to due diligence. Okay, they have conducted this due diligence before the accusation and they have valued this brand. So we are going to talk about this. So you need to understand 3 things. I told you 3 things you need to understand: audit evidence. Okay, audit evidence, assertion that you are going to test, and what else? Procedure. Okay, it should be there for all the audit procedure. So the first one was 700,000. Okay, to test this 700,000 whether it is accurate or not, which places you can visit? What is the audit evidence where you need to look from? See, this 700,000, your case study will always help you. This 700,000 you have got from a due diligence, no? Because this was conducted prior to accusation. So we are going to use exactly that. But you need to select the right audit procedure. Okay? That means you have to use words like review, analytical procedure, observe, inspect, inquiry, discuss. Okay, so these are some of the audit procedure that you can list. You will see every audit procedure as one of these words. So which one do you think? Good thing is whenever it is something to do with documents, mostly it is inspect. Inquire is usually when you have to ask the manager something. You inquire of the management. But here it should, valuation of the brand has nothing to do with the management because managers are not the one who put a value to a brand. You understanding? Now you do analytical procedure because analytical procedures are done to find a ratios or trend like gross profit margin, sale profit margin, return on capital employed, like that. Now you can review because review comes when after you have done a certain thing to check the accuracy. You cannot observe. Observe is usually physically you have to observe a process or something. So what comes? Inspect. Normally when it is something to do with document and all, the word is inspect. Records or documents. So inspect. Inspect what? Due diligence report. From our case study only we got it. Okay. Due diligence report. You can also see another one. Which document? You have purchased this brand. So purchase documentation. Okay. This is intangible assets and purchase documentation to do what? To test what? Cost. To confirm the cost of $0.7 million, or you can write 700,000. It's the same thing. So this is the first analytical audit procedure. Next could be what? Think. What could we see? It's an intangible asset. Brand is an intangible asset. We all agree that, right? IS 38. So because it's an intangible asset, with it comes amortization or impairment. Okay, so we are going to talk about amortization or impairment. That's the next one you can talk. So here, who does this impairment and amortization? Managers does it, isn't it? They are the one who makes a judgment and do an amortization or impairment. So you can inquire. You see, this is how you choose the correct word based on the nature. So you inquire. Whenever you have to ask the manager, use the word inquire. Inquire of management. Okay, inquire of management what? See, one thing they have told in the case study, they believe the brand has an indefinite life. Right? So, inquire of management, why they believe that brand is impairment? Because they told it's indefinite life. Why? You have to question them. So, inquire of management, why they believe the brand has an indefinite life. Okay, so for indefinite life we don't do amortization. Remember, because they have indefinite life, then it's an impairment review. This IS 38 says. That's why you have to know the rules of IS 38 very well. For indefinite life, no amortization. Amortization only comes for definite life. So indefinite life and whether. So that's why it needs like the next line automatically builds up from there. Indefinite life. So therefore whether impairment review. Whether an impairment review has been carried out. When you are referring to a specific standard, you have to list that standard. Okay, you have to specifically write that standard in your answer. Has been carried out as required by which standard? If you write IS 38, that's enough. Okay, IS 38 is intangible asset. If this assumption is made, if you have made the assumption that it's indefinite life. Okay, if so, okay, if that is the assumption that it has an indefinite life, you have to inspect the management's assessment also. If so, inspect the management's assessment, because they have assessed for impairment and also assessment. You have to inspect the assessment and review the assumptions. Remember, wherever estimates assumptions are used, you have to review. Review comes for the assumptions and all and estimates. So review the assumption used for reasonableness, to check whether it's reasonable also or not. Now third. Okay, what's the third? Brand has to do, see, you can extend or decline the brand based on your marketing and all. If you spend on marketing, you might be able to extend the brand. That's how brand works, no? So we are going to talk about marketing expense. Okay, so which audit procedure are we going to use? Inspect advertising invoices, because advertising, brand, they are together. If you want to know how much you have spent on branding, on marketing your brand, you will get it through advertising invoices. Okay, so inspect advertising invoices to confirm the amount spent on marketing. The amount spent on marketing during the accounting year. Okay, which may extend the life of the brand. You have to link this with the brand, which may extend the life of okay, and it also demonstrates that your brand has a strength. Okay, by supporting it with marketing activity, because we told that brand has an indefinite life, so it supports that assumption also. If you spend on marketing and you can support it with the increase in brand's life. Now hereafter onwards, I'm not writing the full answer. You can do it on your own. Answers are written there. What I wanted to show is some common words, like how here I will highlight it for you. Inquire, inspect, inspect. These are an audit procedure. The verbs, the actions that you're telling them. Then these are the evidence, due diligence report from purchase documentation. Then here it is about impairment review. These are the evidences. Okay, here it is on your advertising invoices. These are evidences. Then what about your assertion that you're testing? That I will use a different highlighter. Wait, maybe I will use an orange highlighter. So here you are checking the cost. Okay, I will use another highlighter. Orange is maybe this color. Okay, so cost. Okay, this is assertion that you are testing. Here what is it? Here it is amount, to confirm the amount. Then here you are saying whether impairment review, whether it is reasonable or not. I mean, reasonableness is not exactly a assertion, but assertions will be like completeness, accuracy, then allocation, valuation, like that. So likewise, you have to answer are the audit procedures. I will list something in few keywords. Answers are there. You can always read the answer. Okay. Next is, again you are using inspect. You are again inspecting marketing expenditure. Okay, that is included in the forecast. So inspect marketing expenses forecast. Okay, or budgets. Why? To make sure that marketing stays at that level. Okay, necessary to maintain the brand name. See, we are talking about the valuation of the brand. For it to stay in that value, you have to see all this. What will be the forecast of the marketing expense in the future, like that. Next, again it is related to marketing expense. Okay, so the next one is regarding amortization policy. Amortization will come. It's an intangible asset. So you have to compare this with what? Compare amortization policy with industry. Okay, similar industry, with some competitor brand within the same industry. Okay, to assess whether non-amortization is reasonable or not. And remember, accounts should be publicly available. Okay. And also accounting policy notes should be included for amortization of intangible. Saying that amortization is not done for this intangible should be there in under the note. Then next, compare the performance of the brand. Okay, you can compare the performance of the brand month by month. So again, compare performance of brand. Fill in the blanks. Month by month, you are checking the performance of the brand. Okay, that means from the date you have acquired until now. Why? To see whether performance continues to improve or not. If your performance increases, means your brand valuation will increase. Okay, and it confirms with the management's assumption on the brand strength, saying that it is infinite life. Next, so if you have answered 5, any 5, you will get the 5 marks. But I will include all the possible answers for you so that for your learning purpose it becomes easier whenever a brand or an intangible asset is given to you. Then what's next? Remember, brand has to do with customer complaints and all, right? More the customer complaint, less will be your brand value. So review complaints or returns also, return of your products. Complaints or returns. Because more the return, more the complaint, less will be your brand value. Okay, also remember, complaint and return will lead to what? Impairment of, it leads to impairment of brand. It's an indication of impairment of brand. Next, you can review industry journals. Every industry has some journals. Okay, this is a brand. So review that industry journal. Why? To identify new entrants. There could be risk of new entrant or substitute. If there is a risk of new entrants, okay, or substitute product, remember, again it's a brand impairment. Again impairment comes. And last audit procedure here is obtain a written representation from management. Okay, that means they are confirming in writing that they believe brand is not impaired. Okay, and impairment review has been performed using reasonable assumptions. Who is believing brand will not impair? It is the manager. And who is doing this impairment review based on assumption? Management. That's why you have to get a written representation from them. In writing, they are confirming now. You understand now? Now we'll be doing the next question. Test your understanding too. Here, you have been given 2 items for which you have to design audit procedure. One is a 6% investment. You know, it's not an associate, neither a subsidiary. Okay, it comes under IFRS 9 financial instruments. Next is a bond. Okay, and by the way, you have purchased 1 million shares of $5 per share, 6% holding, and it's not even listed also. Next, additional finance, you have got $1 million 10 bonds at par. Interest is payable at 5%. Bond will be redeemed at a premium on 31st December 2007. So it's for 3 years, 2005, 2006 and 2007. Now, bonds are held in the financial statements and 10 million, obviously 1 million into $10. And interest is in profit and loss account. So for bond and investment in share, you have to design audit procedures worth 10 marks. Whenever question like this comes where straight away they just give 1 mark but 2 requirements, divide equally. 5 procedure for shares, 5 for bonds. Okay, rather than wasting so much of time me writing the procedures, since audit procedures are just a list, what I've done, I've copy pasted the answer. Okay, so I will take you through it. If you see for shares, how many points are there? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 points for shares, which is not needed. And for bond, 1, 2, 3, 4, 5, 6, 7. 7 for bonds. They have given all the possible answers. Okay. So now, you see, I will show you. Agree, inspect, inspect, review, inquire. All these are audit procedures. They start with it only. Inquire, review, inspect. So inspect, inquire, review, these three are very common. That's what you understood, right? From all this. Here, if you go to the bond, agree, obtain, recalculate. Wherever numbers are there, recalculation often comes. Inquire, calculate, inspect. Okay. So now, let's say for shares. Okay. It's for, wait a minute. Let me check the amount. It's 5 per share. Okay. If you multiply it with 1 million, it will be 5 million, 5 million worth of shares. So whether you have received that much cash, always easiest point is to check with cash whether you have received or paid something. That is the easiest. In case you are thinking too much or confused with audit procedure, start with the easiest things first. Something that you have paid in cash, it's very easy. Check the cash and check the bank statement. Okay, and you can even write the amount. So agree the cash paid of 5 million with bank statement and cash book. Very easy. Almost all the places is bank statement, cash book, bank statement, cash book. Okay, regarding the purchase of the 1 million, because for that purchase you have to pay in cash. And where are you going to test whether you have paid in cash? Through your bank statement and cash book. Okay, so it's done. Next, whenever some share purchase takes place, next place is board minutes. So these are evidences. Okay, this bank statement, cash book, board minutes, these are evidences, source of evidences. You will have it in every audit procedure. Okay, but source of evidence will be different. So here you inspect, because mostly inspect, you have to inspect documents and all. Inspect board minutes of that company, whatever the company is, gig company in this case. Okay, so inspect their board minutes. Why? For evidence that investment has been classified at this, that is FVOCI, with standard according to SBR. SBR, it is IFRS 9, financial instruments. Whether, because it is share. Okay, so in case you forgot IFRS 9, which is very likely, you must have. Why? IFRS 9 is a very challenging standard, plus it's very lengthy. Okay, I don't know how many of you have seen my IFRS 9. If you have not, please go to my SBL lecture today itself, right now, and check IFRS 9 before we proceed ahead. This will serve two purposes. One, you'll be thorough with your SBR knowledge as well, IFRS 9. The other one, AAA also. Okay, and IFRS 9 you anyway have to know, because it's very challenging standard, and challenging standard has a more chance of coming in AAA, because risk of material misstatement are more in this area where things are complex, and IFRS 9 is one of such a standard. So it's always better if you are very aware of IFRS 9, very thorough with it. Okay, so when it comes to shares, we know financial instruments could be of two types, debt and equity. Share comes under equity. Equity, you cannot reclassify it to profit and loss. Okay, so it is fair value through other comprehensive income. Once you have designated, it will be this. So to make sure that they are through this, okay, that's why you're going through board meetings. For an evidence that investment has been classified as this, FVOCI. Just give me a minute. Have they mentioned anything about it? No. Okay, so you can talk about it. Third audit procedure regarding financial instrument could be what? Regarding shares. See, this has to, most of the things, one thing is fair value is there. So third could be fair value. Okay, so if it is classified as fair value through OCI, FVOCI, then you inquire you inquire the management. Inquire always often comes with the management, unless it's a third party that you are asking. So inquire management to confirm that they do not tend to trade the shares in the short term. According to this, also comes from your rule of IFRS 9. If you know IFRS 9, you understood this. There it says shares that are traded for short term, okay, does not go through fair value through other comprehensive income, okay. But if they are not traded for short term, usually they are not traded for short term, okay. If they are not, then only it is FVOCI. So to confirm that it is FVOCI, you have to make sure managers have to confirm that shares are not traded for short term. Done. Fourth, inspect again, where one is profit, the other one is cash flow forecast. Why? To verify that shares are not expected to be sold within the next year. You have to verify the shares will not be sold within the next year. Why profit and cash flow focus? See, when you are selling the share, okay, or not selling the share, whatever, when you are not, let's say, sell, where will it have an impact? Two places. One is cash flow, why you are going to receive cash for selling that share. The other one is profit. You are going to have a profit or a loss on that disposal of share. Okay, that's why you have to inspect your profit and cash flow to verify that shares are not expected to be sold. That means your profit and cash flow focus will not increase. What's next? You can check past. Okay, share is something for which you have a past. So review the past share sales and assess if they have a history of trading shares in the short term. You have to see this, whether they trade for short term from various angles. You see, it was here also in this thing is here also. You are confirming from the manager that they're not trading for short term. You're reviewing the past sale shares also to review that, to confirm they are not in the short term. You see, sometimes more than one places you might be having the same thing, confirming the same thing only, but source of evidence will be different and your audit procedure will be different. Here you ask the manager, here you reviewed the past. Next, again inquire. You are inquiring the manager what? If legal or broker fees were incurred on the share issue. Obviously, when you're issuing a share, there must be some legal or broker fee that has to be incurred. Okay. If there is any cost, agree this to invoice. Okay. Remember, it goes through this. Okay. They should be expense if the investment is measured at fair value through this profit and loss. But if it is through this, they are added onto the carrying amount. Two different treatments. Remember, if investment is measured at fair value through profit and loss, it depends on the investment. If it is measured through FVPL, legal and broker fees are expensed. They go through profit and loss as an expense. But if it is through other comprehensive income, you cannot say it goes through other comprehensive income. Rather, legal and broker fees you add to the value of the share, the financial instrument value, right? You add it to their carrying amount. That's the rule according to IFRS 9. Don't ask me why. You need to go back to IFRS 9 and know the rules first. So this is done, this is done. Okay, at least 5 points. If you write, you will get 5 points. But since all the answers are there, let's explain all the answers. It's always safe side to know more than the required points, so that when it's time to write just few points out of the list, you are in a position to write the things which are very easy for you to explain. Okay, next, again inquire. You see, you must have been using more than one audit procedure, but for different purpose. Once you are inquire manager for legal and broker fee, other time you are inquiring manager to see whether shares are not traded for short term. Different purpose, but now again you are inquiring manager for as to how the fair value of non-listed shares has been determined. Remember, this told shares are non-listed. If shares are listed, there is no doubt. It's very easy to get the fair value because they are published. But if it's not listed, then question comes, how did the manager determine the fair value? This you have to ask the manager. Ask means inquire. I always use ask for inquire. So it's done. Then comes review. Again fair value. Same topic, fair value, but more than one places audit procedure has been tested. Review the fair value calculation for accuracy. This is assertion that you are testing. And also, because fair value is based on some assumption, assess that assumptions also. Reasonableness of that assumption. Always, any standard where assumptions are used, always write this word. Check the reasonableness of the assumption. Check the reasonableness of the assumption. Okay, repeat it. Which standard? IFRS 13. Assess the level of input used as per IFRS 13. To know this also, you have to go back to my SPL lecture IFRS 13. Briefly, I will explain you here. IFRS 13 says there are 3 levels to measure fair value. Level 1, level 2, level 3. Level 1 is the most safe and most reliable. Like it is more preferred over the other two. That means for identical products, you are getting the price, open market price. Okay. This is very easy if the shares were listed. But since it is not listed, you must have used level 2 or level 3. Level 3 is not preferred, is most dangerous. Level 3 is where you are not getting any input. Maybe you have a unique intangible asset or easily you are not getting it. So you are getting the fair value based on some predictions on your cash flow, future cash flow. So you discount your cash flow and find the present value. That's how you get it. Stage 2 is in between the stage 1 and 2. Level 1 and 2. It is not for exactly identical, but with some adjustments with that you will get. I mean, how do I say? It's for similar, okay, similar product you might get the fair value. So level of input, we don't know whether it is level 1, 2 or 3 yet. So you have to assess that level of input that you have been used in IFRS 13. Okay, next. Now inspect the financial statement. Why? Why? To see the revaluation loss. Okay, to see where the revaluation loss has been recorded. Where? Is it profit and loss or other comprehensive income? And assess if this is consistent with the classification of the financial asset. Remember, investment in share is a financial asset. You need to know this first definition according to IS 32. Yes, financial asset has been explained in IS 32. Classification of financial asset, financial liability and equity. IS 32, sorry. Whereas measurement recognition of financial instrument is under IFRS 9. And IFRS 7 is on disclosure. It has to be consistent, okay? Remember, if you have classified a financial asset like through profit and loss, the gain and loss also will go through profit and loss. If you have recognized it as a other comprehensive income, gain and loss also will go through OCI. So it has to be consistent. To check that consistency, you have to inspect financial statement to see whether the gain and loss are recorded. Revaluation gain and loss are recorded. You see? Now, next time, whenever you are given financial instrument or financial asset in your exam, it becomes very easy for you because most of the audit procedures are listed here. Very easy for you to pick up. Okay. Next, inspect the financial statement disclosure. This is IFRS 7. IFRS 7 talks about financial statement disclosure. 3 standard talks on financial asset alone. That itself should show you how important and complex financial instruments are. That's why 3 separate standards. Anyways, so inspect their disclosure regarding what level of input used to measure the fair value of share. Because in disclosure, they will write it, which level they have used to measure fair value. Next, bond. Bond was at 10 million, I remember. So it's very easy. Agree the cash receipt of this bank statement and cash book. You see, same as share. Second, interest payment. You must have paid interest. Check this also with the bank statement and cash book. Again, very easy. Third, get documentation. Relating to what? Bond issue. To verify the interest rate and redemption premium. Because through documents only you can say that this much is the interest for the bond and this much is the redemption with premium. Then recalculate. Wherever you are doing the calculation again to check, it's called recalculate. So recalculate the effective rate of interest on the bond to check the accuracy. Then inquire of management. What is it? Ask the management regarding if legal or broker fees were incurred on the bond issue. Did you take this also into the account? If so, it should agree to the invoices. Okay. And audit adjustments would need to be proposed to deduct this from the initial carrying amount of the liability. Okay. You have to do some adjustment to it. What is it? Deduct this from the initial carrying amount of the liability. See, if you have some bond, what do? Interest payment and all. If you have made it, it is supposed to be reduced from the carrying amount of the bond, because your carrying amount now you have to pay less and less if you have paid the interest in installments. So if you are taking this also, legal and broker fee, that will be reduced from the carrying amount of liability. Okay. Next, calculate. So calculate the audit adjustment required so that finance costing profit and loss is based on an effective rate of interest. And finally, the last one is inspect the financial statement. Why? To ensure that liability in respect of the bond is correctly classified as non-current. As non-current, okay. Why? Because it's for 3 years. If you see, bond is for 3 years, so the liability will be non-current, not current. Okay. Currently, it is correctly classified as non-current, the liability for bond. So thank you for watching, and I shall see you in the next lecture, which is using the work of others. Using the work of others means it could be auditors expert, managers expert, internal auditors work, service organizations, all those things. Okay, when you are collecting evidence, when you're collecting audit procedure, designing audit procedure, sometimes in the process you must be relying on others as well, right? Internal auditors work and other experts, others might be reviewing things like that. So that's why we are taking that also into consideration, but in a different lecture. The reason is because already this lecture is pretty much long enough. Okay, so anyway, that's it, and hope by now you are in a sound position to answer any questions and able to design any audit procedure for any element given to you right after this lecture. Make sure go to your revision kit, pick up questions on audit procedure and evidence, and try to do the audit procedure on your own without looking the answer, and then match what are the things that are matching. Check the format that you are answering. Are you applying the correct format of answering audit procedures or not? That's the fourth step. That is audit source of evidence, assertion that you're testing, the audit procedure like review, observe, what word are you using, and checking whether you are complying with the standard, applicable standard from your SBR. So like this, you have to combine and write an answer, full-fledged answer. Okay. And don't forget to subscribe to my channel and make sure that you watch my previous lecture as well, because the more forward we move in AAA, you need the support of my previous lecture. So you cannot forget the previous lecture when we come here. You always have to keep revisiting and reviewing it. Okay, otherwise you will forget. It's very easy to forget AAA, trust me. Okay, because it's more of discussion, more of theory compared to calculation and numbers like that. That's why it's easy to forget. So be very specific when you're writing audit procedure. Don't write general audit procedure, specific to the case given to you. Okay, and I shall see you in the next lecture. Thank you for watching and take care.